For years, the global banking system has projected an image of stability. Capital ratios look stronger than they did before the financial crisis. Stress tests are published. Regulators speak in measured tones. On the surface, everything appears controlled. But beneath that surface, something significant has been happening. Quietly, methodically, an estimated $750 billion in risk exposure has been transferred within the global financial system. Not erased, not destroyed, transferred. That distinction matters. When we hear a large number like $750 billion, it is easy to react emotionally. The figure sounds enormous, yet in the context of a global banking system, measured in the tens of trillions, it is not automatically catastrophic. The number alone is not the story. The movement is the story. So the central question becomes simple and direct. If risk is being moved, who is holding it now? To understand why this matters, we first need to clarify what a risk transfer actually is. In plain terms, banks make loans, hold bonds, and finance large pools of assets. Those assets carry risk, the risk that a borrower defaults, that interest rates change, or that asset prices fall. Traditionally, banks would hold much of that risk directly on their balance sheets. But modern finance allows something more flexible. Through derivatives, credit default swaps, structured products, insurance contracts, and special investment vehicles, banks can shift portions of that exposure to other institutions. They can package risk, slice it into pieces, and sell or hedge it. Think of it like moving weight from one shelf to another. The total weight in the room does not change. It is simply redistributed. In theory, this redistribution can make the system safer. If risk is spread across many strong hands, no single institution becomes overloaded. Diversification, when transparent and well managed, reduces fragility. But there is another possibility. Risk can also migrate toward entities that are less regulated, less transparent, or more leveraged. In that case, the system may look stable at the center, while pressure quietly builds at the edges. This is why the direction and opacity of the $750 billion matter more than the raw figure itself. Where did it go? Was it absorbed by well-capitalized insurers and pension funds? Did it move into private credit funds, searching for yield? Was it shifted across borders, into jurisdictions with lighter oversight? We do not yet have complete clarity. And that uncertainty is the point. Financial systems rarely break because of one obvious number. They strain when complexity rises and visibility falls. When risk becomes harder to trace, confidence becomes more fragile. Participants begin to rely not on transparency, but on assumptions. Right now, the data suggests that banks are adjusting. Higher interest rates have changed the value of bonds. Commercial real estate faces pressure. Sovereign debt levels are elevated. In this environment, managing exposure becomes a priority. Moving risk off balance sheets can preserve capital ratios and stabilize reported metrics. From the outside, balance sheets may appear stronger. Ratios may improve. Headlines may remain calm. Yet underneath, the internal architecture is being rearranged. This is not a dramatic collapse. It is not a sudden shock. It is a structural shift. And structural shifts are often more important than sudden crises because they reshape incentives. They change who absorbs losses when stress appears. They redefine where fragility sits. So again, we return to the essential question. If traditional banks are transferring exposure, who now carries the burden when markets tighten? To answer that, we need to examine what has changed in the broader financial environment and why institutions feel compelled to move risk now. To understand why institutions are moving exposure now, we need to step back and look at how the rules of the system evolved. Before 2008, large banks often held significant credit risk directly on their books. They originated mortgages, corporate loans, and sovereign bonds, and they carried much of that exposure internally. Capital buffers were thinner. Derivatives markets were large but less transparent. Risk modeling assumed liquidity would remain available in stress. Then, the financial crisis exposed the fragility of that structure. When housing prices fell and complex securities began to fail, the system froze. Counterparties no longer trusted each other. Funding markets tightened. Governments stepped in. The response reshaped banking. New regulations increased required capital ratios. Stress testing became routine. Liquidity coverage ratios forced banks to hold more high-quality assets. Derivatives clearing was pushed toward centralized platforms. In simple terms, banks were told to hold more cushion and show more of their cards. For more than a decade, this framework appeared to work. Balance sheets improved. Capital levels rose. The system looked sturdier, but stability has a cost. Higher capital requirements reduce return on equity. Stricter liquidity rules limit flexibility. Profit margins compress. Now another shift has occurred. Interest rates have risen sharply after years of near-zero policy. That single change has wide consequences. When rates rise, bond prices fall. Banks that accumulated government debt during the low-rate era suddenly face unrealized losses. Commercial real estate loans, once safe and predictable, begin to look vulnerable as refinancing costs climb. Sovereign debt burdens expand as governments roll over obligations at higher yields. In this new environment, holding large pools of long-duration or credit-sensitive assets becomes more expensive in capital terms. Even if those assets are fundamentally sound, they consume regulatory space. And regulatory space is finite. So institutions adapt. Instead of retaining the full exposure, they hedge it, they securitize it, they insure portions of it. They enter into swaps that transfer specific slices of risk to counterparties willing to take it for a price. This is where the signal emerges. When risk transfers accelerate during a period of tightening financial conditions, it tells us that two forces are colliding: risk appetite and capital constraint. Investors still seek yield. Pension funds still need returns. Insurance companies still allocate to credit products. At the same time, banks face stricter leverage ratios and mark-to-market pressure. The result is migration. Risk moves outward. It flows toward non-bank financial institutions, often described collectively as the shadow banking sector. These entities are not illegal or hidden in a dramatic sense. They include private credit funds, structured investment vehicles, reinsurance firms, and cross-border asset managers. Many are sophisticated and well-managed, but they are regulated differently. Disclosure standards vary. When risk changes hands, it also changes context. A bank funded by stable deposits behaves differently from a leveraged fund financed through short-term borrowing. An insurer with long-dated liabilities evaluates volatility differently than a pension fund with political constraints. So the question is not whether risk exists, it always does. The real question is whether the new holders of that risk can absorb stress without transmitting it back into the core banking system. Historically, spreading exposure across many participants can increase resilience, but concentration in opaque corners can amplify shocks. The difference often becomes visible only under pressure. This is why the current shift matters. Higher rates, elevated sovereign debt, and weakness in commercial real estate are not isolated problems. They are stress points. If capital rules make it costly for banks to retain exposure, and if yield demands encourage other players to accept it, then the system's center of gravity moves. The surface may appear calm. Regulatory ratios may look compliant. Yet underneath, incentives are evolving. Risk appetite is still alive, but it is operating through more complex channels. Which brings us to the deeper layer of this story. Beyond regulatory shifts and financial engineering, what larger economic forces are pushing this redistribution of exposure in the first place? The deeper layer begins outside the walls of any single bank. Risk transfers are not happening in isolation. They are a response to strain in the real economy. To see the full picture, we have to zoom out from balance sheets and look at supply chains, energy flows, and sovereign debt burdens. Finance is a mirror. When the real economy shifts, financial structures adjust. Over the last several years, global supply chains have become more fragile. Geopolitical tensions have reshaped trade routes. Shipping costs have fluctuated. Critical inputs like semiconductors, rare earth minerals, and industrial metals have experienced bottlenecks. Companies that once relied on smooth global integration now face delays, higher costs, and strategic uncertainty. When supply chains fracture, corporate margins compress. Firms must hold more inventory. They must diversify suppliers. They must invest in resilience rather than pure efficiency. All of this requires capital. At the same time, energy prices have become more volatile. Energy is not just another commodity. It is a base input into transportation, manufacturing, agriculture, and digital infrastructure. When oil or natural gas prices spike, operating costs ripple across industries. Some firms can pass those costs on to consumers. Others cannot. Higher input costs weaken balance sheets. Slower revenue growth reduces cash flow. Debt that looked manageable in a low-rate environment becomes more burdensome as refinancing costs rise. This is where banking mechanics intersect with economic reality. If corporate borrowers appear less stable, banks reassess exposure. They tighten lending standards. They hedge loans tied to vulnerable sectors. They transfer portions of credit risk to external investors. But the adjustment does not stop with corporations. Governments are also under pressure. Sovereign debt levels have climbed steadily. During years of low interest rates, issuing debt was relatively inexpensive. Now, as rates rise, the cost of servicing that debt increases. Budget deficits widen. Governments face difficult choices: raise taxes, cut spending, or issue more debt. Each option carries economic and political consequences. Bond markets respond quickly to perceived fiscal weakness. Yields adjust. Currency values shift. In this environment, leverage becomes a central theme. Who has it? Who controls liquidity? Who can absorb volatility? Central banks hold enormous influence. Through interest rate policy and balance sheet operations, they shape funding costs and asset prices. Sovereign wealth funds manage vast pools of capital derived from commodity revenues. Large institutional investors, including pension funds and insurance firms, allocate trillions across global markets. Major commodity producers influence the supply of energy and critical materials. These actors operate on different time horizons and with different constraints. A central bank seeks price stability and financial order. A sovereign wealth fund seeks long-term returns. A pension fund must meet future obligations. A commodity producer responds to market prices and geopolitical realities. The real battle is not about daily stock market fluctuations. It is about who absorbs volatility when shocks occur. Banks, facing regulatory and capital pressures, aim to reduce concentrated exposure. Investors, facing return targets, are willing to take measured risk. Governments seek stability to maintain social and economic continuity. Each participant has incentives that sometimes align and sometimes conflict. When risk transfers accelerate, they signal negotiation within this system. Exposure is being redistributed according to capacity and constraint. Headlines often focus on equity indexes, rising or falling, a few percentage points. But the deeper story unfolds in collateral agreements, funding markets, and derivative contracts. Modern finance is layered. A corporate loan may be bundled into a security, insured through a credit derivative, financed in a repo market, and ultimately held by an overseas fund. In that chain, trust is the invisible glue. Each link assumes that the other will perform. Liquidity depends on confidence. If one layer hesitates, the effects can move quickly across borders. Consider how rapidly capital can shift. A bank in New York hedges a portfolio of commercial loans through a swap with a European counterparty. That counterparty reinsures part of the exposure with an Asian insurer. The insurer offsets risk through structured notes sold to global investors. Within days, exposure that began in one market becomes dispersed across continents. This interconnected web is efficient in calm conditions. It allows risk to be shared. It supports liquidity and growth. But it also means that the location of risk matters more than the headline number. If the new holders of exposure have strong balance sheets and long-term funding, the system can absorb stress. If they rely on short-term borrowing or face sudden redemption pressures, strain can reappear unexpectedly. So the question evolves again. It is no longer simply about whether $750 billion moved. It is about where it settled within this web of supply chains, sovereign finances, and institutional power. And once we understand where risk sits, we must confront the next layer of consequence: how these structural shifts in exposure influence money itself, currencies, inflation, and the value of assets over time. Once risk settles into new hands, the story moves from institutions to money itself. Exposure is not just an accounting entry. It shapes liquidity, credit creation, and ultimately, the strength of currencies. The chain begins with interest rates. When central banks raised rates to combat inflation, bond prices fell. That is a mechanical relationship. Higher yields reduced the market value of existing fixed-rate bonds. Banks that accumulated large bond portfolios during years of low rates suddenly faced unrealized losses. Even if those bonds were high quality and likely to pay in full at maturity, their mark-to-market value declined. That decline affected capital ratios and investor perception. It increased sensitivity to funding costs. In response, banks adjusted. They shortened duration. They hedged interest rate exposure. They transferred slices of credit risk to external counterparties. These actions are rational. They are forms of balance sheet management, but they also have broader effects. When banks become more cautious, lending standards tighten. Credit becomes slightly harder to obtain. Marginal borrowers face higher spreads. Businesses delay expansion plans. Real estate projects slow. Consumers reconsider large purchases. This is how risk transfer influences liquidity. It does not require a crisis. A gradual tightening of credit conditions can shift the pace of economic activity. Slower growth has fiscal implications. Governments collect less tax revenue when economic momentum fades. At the same time, interest expenses on outstanding debt rise as bonds roll over at higher rates. Budget deficits widen. To cover those gaps, governments issue more debt. More debt issuance places pressure on bond markets. Investors demand yields that compensate for inflation risk and fiscal uncertainty. If confidence remains high, the adjustment is orderly. If confidence weakens, yields rise more sharply. Currencies respond to these dynamics. A country with rising deficits and slower growth may see downward pressure on its currency, especially if markets expect future monetary easing. Conversely, if interest rates remain high relative to peers, capital may flow inward, supporting the currency temporarily. The key point is that money is not isolated from banking adjustments. When risk is transferred and lending tightens, the ripple effects move through growth, fiscal policy, and exchange rates. Consider the sequence clearly. Risk transfer reduces direct exposure on bank balance sheets. Reduced exposure often accompanies tighter credit conditions. Tighter credit slows economic expansion. Slower growth strains government budgets. Fiscal strain influences bond issuance and investor confidence. Bond dynamics shape currency strength. This chain is not dramatic. It unfolds over quarters and years. But it is powerful. Now we introduce another layer: assets that sit outside the core credit system. Gold is often discussed in this context, not as a prediction tool, but as a historical reference point. For centuries, gold has functioned as a store of value, independent of any single government's balance sheet. It carries no counterparty risk. Its value does not depend on a borrower's promise to repay. In periods when trust in financial plumbing weakens, capital sometimes rotates toward assets perceived as outside that plumbing. This does not always signal crisis. It can reflect portfolio diversification in response to uncertainty. Other real assets, including certain commodities, can serve similar roles. When investors question long-term currency stability or fiscal sustainability, they often seek instruments that are less directly tied to credit expansion. However, it is important to avoid simplistic conclusions. A move toward safe assets does not mean the system is collapsing. It often indicates recalibration. Investors balance exposure between growth-sensitive assets and stores of value. Central banks also influence this equation. If tightening leads to economic slowdown, policymakers may eventually ease conditions. That could mean cutting rates, slowing balance sheet reduction, or providing targeted liquidity facilities. Such actions support growth but can place downward pressure on currencies if perceived as inflationary. So the system adapts. Banks adjust exposure. Investors rebalance portfolios. Governments manage deficits. Central banks recalibrate policy. Each adaptation solves one problem while creating new incentives elsewhere. These are the second-order effects. They are rarely visible at the moment risk transfers occur. Instead, they appear later in credit spreads, currency charts, and fiscal debates. The important insight is that no adjustment happens in isolation. Financial engineering at the institutional level can reshape money itself. And once money shifts, the impact eventually reaches households, retirement accounts, and everyday financial decisions, which brings us to the personal dimension of this structural change. When structural shifts move through money and credit, they do not stay confined to institutions. Over time, they filter down to households, workers, and savers. The impact is rarely immediate. It appears gradually, through conditions that feel tighter, slower, or more uncertain. One of the first effects is credit availability. If banks hedge more aggressively or move risk off their books, they often lend more selectively. Mortgage standards may tighten. Small businesses may face higher borrowing costs. Credit card rates may remain elevated for longer. None of this signals collapse. It reflects caution. For a household, tighter credit can mean delayed home purchases, slower refinancing activity, or reduced access to expansion capital for family-owned firms. When many households and businesses delay decisions at the same time, economic momentum softens. Employment growth may slow. Wage increases may moderate. Investment plans become more conservative. These shifts are subtle, but they accumulate. Retirement portfolios also feel the effects. Pension funds and insurance companies are often among the institutions that absorb transferred risk. If they allocate more capital to structured credit or private lending vehicles, their returns become tied to those exposures. In calm conditions, this can enhance yield. In stress conditions, volatility may increase. For individuals with 401k accounts or defined benefit pensions, these changes are not visible day to day. But over time, performance reflects the broader financial environment. Bond yields, equity valuations, and credit spreads all respond to the same liquidity dynamics we discussed earlier. Mortgage conditions can shift as well. When bond markets demand higher yields due to fiscal pressure or tighter liquidity, mortgage rates often follow. Housing affordability becomes more sensitive to rate movements than to home prices alone. These connections can feel abstract. That is why simple mental models are useful. They help translate complexity into principles. The first model is straightforward. Risk never disappears, it migrates. When you read that banks reduced exposure, understand that someone else increased it. The key question is who, and under what constraints. This mindset prevents complacency when balance sheets appear stronger on the surface. The second model is equally important. Liquidity is the system's oxygen. When credit flows easily, businesses expand and asset prices stabilize. When liquidity tightens, even healthy firms feel pressure. Watching indicators of funding stress and lending standards can be more informative than focusing solely on stock indexes. The third model is about structure. Complexity increases fragility. Modern finance is efficient but layered. Each derivative contract, securitization, and cross-border allocation adds connections. Connections can distribute risk, but they can also transmit shocks. Understanding that trade-off helps interpret why regulators care about transparency. It is also important to maintain balance. Not all risk transfers are negative. Diversification can strengthen resilience. If exposure is spread across well-capitalized institutions with long-term funding, the system can absorb stress more effectively than if risk were concentrated in a few large banks. The concern arises when transparency declines or when leverage builds in corners that are not closely monitored. Concentration, not movement itself, is the issue. For individuals, the takeaway is not to predict collapse. It is to recognize that macroeconomic shifts unfold over years. They shape interest rates, credit access, and asset returns gradually. By applying clear mental models, it becomes easier to interpret headlines without overreacting. And once we understand how these forces reach households, the final question becomes unavoidable. Where could this evolving structure lead next? And what scenarios should we realistically consider? The natural next step is to consider where this structure could lead. not through prediction, but through plausible paths. Financial systems rarely move in straight lines. They adapt, they tighten, they release pressure, and sometimes they surprise. The first scenario is controlled deleveraging. In this outcome, risk transfers continue, but they settle into institutions with strong balance sheets and stable funding. Growth slows modestly as credit conditions remain firm, yet not restrictive. Central banks maintain credibility. Inflation trends gradually lower. Bond markets adjust without disorder. In this environment, volatility appears in waves but does not cascade. Banks hold higher capital. Non-bank institutions manage exposure prudently. Governments refinance debt at manageable levels. The system absorbs stress slowly, like air leaking from a tire, rather than a sudden rupture. This is not dramatic, but it is realistic. Many tightening cycles end this way. The second scenario is a liquidity event. Here, a weak link struggles under the weight of transferred exposure. It could be a leveraged fund facing margin calls. It could be an insurer mispricing long-duration risk. It could be a regional bank exposed to a narrow asset class. In such a case, stress emerges quickly. Funding markets react. Counterparties reassess risk. Liquidity thins. Central banks may step in with targeted facilities to stabilize conditions. Importantly, this type of event does not require the entire system to fail. It requires only one concentrated node to falter. The speed of modern finance can amplify localized weakness. The third scenario involves policy reversal. If economic slowdown accelerates or fiscal pressure intensifies, central banks may pivot sooner than expected. Rate cuts, balance sheet expansion, or emergency liquidity programs could return. Such measures would aim to support growth and prevent instability. However, rapid easing carries trade-offs. It may weaken currencies, especially if inflation remains above target. It may encourage renewed risk-taking. It may relieve immediate pressure while planting seeds for future imbalances. Across all three scenarios, one theme remains constant: uncertainty. The system is adaptive, but parts of it are fragile. Risk has not vanished, it has shifted. The resilience of the next cycle depends on who now holds that exposure and how they are funded. We may not know precisely where every dollar of transferred risk resides, but we can ask sharper questions. Which institutions have grown rapidly in recent years? Which rely on short-term financing? Which operate with limited disclosure? If traditional banks have reduced their direct exposure, then systemic leverage may now sit elsewhere. And that leads us forward. Who truly holds the balance of power in this evolving financial structure? And what happens if that layer becomes the next source of strain?